something called inducement template. This. You want to draw this or take a screenshot of this. Let me get rid of this. Either this or this. Okay, it's called inducement. Inducement means that this low here is left there purposely for price coming back to attack this low. Okay, and it's got to do with if you remember the lesson that we did on when price is going to respect the breaker, or price is going to come back into the order block. All right, it's got to do with that. So here what price did is essentially it came close to hitting the bullish order block, okay, but it didn't hit it. Or even if it did with a very small shallow hit or the high, and then price will go up. If you start seeing it coming back down, that's exactly the level they're coming for. But this is just me showing you theoretically. But if you look on the chart how I pointed them to you, that's how you want to see them. So you're going to see the order block, and you're going to see a short-term high or a short-term low formed round near the order block. And if you pay attention or you study the order block, you will see, did they actually hit it, or did they form this low as an inducement to trap people thinking, okay, we went long here, we're going to leave our stop loss here. And the same thing applies to the sell. I've already shown you a couple of sells ideas as well. Right, this high here is usually induced. Price is going to come back and attack it and then drop. All right, and let me show you a couple of buy examples, because I've shown you some sell examples. Let me show you some buy examples. So the way you will see these trades is identify first of all where an order block is. Okay, so identify where an order block is. You are going to see the inducement like this one here, right there. So identify the order block. This is the inducement. Price is gonna attack that one and then go up. Okay, let me see if I can find another example. Which one is this? This one is euro. This looks like an inducement. Okay, this low here looks like it's an inducement that in future when price comes back, okay, when price comes back, it's gonna attack this low. I wouldn't think it's gonna go exponentially to the upside, but it's gonna cause some form of a reaction. It's gonna cause something like this. All right, now the secret and how you know that it's an inducement is this here. The breaker. Okay, the breaker. Anytime you want to see if it's an inducement, look at the breaker. Okay, because it's the breaker that will stop it from actually going. So this one might look like the opposite of a market structure break, because if you see it this way, give me 1 second. The little king just jumped in. What's up? Okay, sorry for that. The little king just jumped into the room. All right, so how you know that it's not going to go down, because this one, when it happens, you might think that price is going to continue going lower here, because it's going to give you that same template that you see here. See that this is a low, that's a high, and that is a break of this low. So you might think that, okay, this is going to do what? Break and go down, but that's not the case. Okay, it's how price formed down here is what is going to give you the clue that this is going to react and go up, and typically it's a bullish order block, and then the opposite is true for the sell. Right, so price is going to do this. It's going to form a short-term low here. It's going to break down, and it's going to come back up again, and now it's going to drop. Okay, this is how price is moving all the time. Okay, you might not see it, but this is how price is moving all the time. Now, your attention has not been brought to it because it might have happened and you were simply in that trade and you never paid attention to it because you were still long. So when price came here, you bought it, you were still long, it came back, you believed that it's going to continue going up. But now I'm bringing your attention to it so that you will see how it actually works. So when you see it, you can actually buy more again, or you can sell more again. All right, because this has happened all the time, but you just simply believed that price is not gonna go and stop you out. Why? Because I know I've given lots of trades that did the same thing. Where was it? Euro New Zealand, back here. In here, oops, here, right? If you remember, when I gave a buy for us to go up, it came here, it went up, and then it came back down deeper into the other block, and I told you guys to do what? To adjust the stop loss, because I think all they are trying to do is go deeper into the other block, which was the rejection block here, right there. And then ultimately, what did price do? Price rejected and then went up. That was an engineered liquidity. This low here, that low was an engineered liquidity. So buying here, price went up and then came back down again to take out that low. Why? Because it's engineered. They will take that one out before going up. And the same thing applied to the Euro Aussie long that we took that same week. That was right here. All right, took the long, went up, came right back down to take out this low right there before it went up. But you just simply trust that this low is not going to be taken. Why? Because it's another block. If you go in the lower time frame to study that, this is what you're going to see. You're going to see this. So you trust that this low is not going to be taken. Therefore, anything coming down is what? Inducement. Now that you are aware, you will be, we call it unconscious incompetence. You were not aware, but now that you're aware, you will start paying attention to it to know, okay, when price came to hit the order block, did it go to the actual order block, or is that low inducement? If it's coming back down again, now I understand why it's coming back. It's only coming back to attack a low and then go up. It's not going to stop me out. So I'll be confident if with enough back testing, or with enough time spent on the screen, you can actually buy again even more here to take price up. Okay, you be confident to buy more to take price up. Why? Because you know why price should do that, and it's called inducement or engineering of liquidity. Remember the first lesson that we did about liquidity? I said that if they are buying and they don't have enough if they are buying, okay, and they don't have enough, or they've not bought enough and price went up, what is he gonna do? It has to go to a logical point that people are willing to take the other side of that trade. No one is willing to buy up here. Sorry, no one is willing to sell to them up here. No one. And probably not enough liquidity. So where is it going to be? Here. Why? Because once price starts moving, if I'm an institution and I invested 100 million here, right, and price moved my way and I'm in profit of about let's say I'm in profit of about 200 million, would I want price to come all the way back down here to take me out? Hell no. I'll push my stop loss here at least to cover 120 million as my profit. Now you taking your profit there, what is it going to be? This is going to be selling. And what do they want? They want you to sell so they can buy it off from you. Okay, and then price will push away. So that's what is actually happening here. So someone bought the order block. We don't know who, doesn't matter anyway. Someone bought the order block, it went, and then what happened? They didn't buy enough. Come back down. Anyone that bought already, boom, their stop loss gone, and then price move their way. Right? Same thing here. Now once you start seeing this, it will be heartbreaking to see sometimes why you get stopped out and then price goes your way. So this low to this high, this order block, engineered liquidity. If I drop down to the 15 minutes, you're going to see it properly. Here, price goes down, it goes up, thinking you're making money, right? Boom, comes right back down to take you out, and then rally, right? And then the actual move happens. If you start seeing this, man, it's so disheartening. And sometimes the way price, the reason why again I investigated this is, why do my trades stops me out and then go my way? That's what leads to getting the understanding. Why does trade stops you out and go your way? You start from there, because once you understand why it stops you out and then it goes your way, then these things are going to be clear to you why it does it. Okay, so your studies or your understanding should be hinged around, okay, so what actually takes place when they're taking me out? What has already transpired? Did it run stops first before going up? Because if it did, then this buy that I got in was an early buy, so they came back down to hunt me down. Now if you have this, give me a second, if you have this and it forms the order block again, give me 1 second, let me breathe, because if you pay attention to price, right, you will see that sometimes an order block will form and it will have this formation, right? How is this? Your question will be, how is it this formation? You have the down candle, you have the up candle here, and then you have another up candle there. Okay, you have the other up candle there. So what is this? This is the order block. Okay, so in the lower time frame, you are seeing something like this. So when the order block is, or when price forms something like this, you want to study how the order block is within that. You are going to see something like that. Okay, that is we call it mitigation. Price will come back down, take out this low, and then rally. This is an example of this here. Here, notice that this down candle, right, is higher than this one. Okay, this down candle is higher than that one. It's not engulfed, it's not like this. Okay, it's not engulfed, it's not like this, because if it's engulfed, then this will be that, and price will come back, and then it should respect here and then go up. We don't have that here. This is just a normal candle. So in the lower time frame, it looks like what? Lower lows. It's like a trend line. So what is going to be? It's going to be easy for price to run through it. Now compare that to something like this. Either this or that one. What this one has done is we have a high, we have a low, we have a high. So we have breaker forming the order block. Therefore, price will respect and then go up. But if you have it this way, it's always going to be easy for price to run it there. And there was another example here, right here. Okay, price runs it very, very easily. Why? Because there's nothing like this here. Therefore, it's easy for price to run it. Now look on the upside. What have they formed there? Is there any engineered high? Did price form any engineered high? No. So there's a chance that price is going to go all the way up, hit this, and then drop. If it goes all the way up and then forms a short-term high here and then drops, what are you going to think about this going forward? That is what? An engineered high. You will pay attention to this because future price is going to come and take out this high and then drop.